Welcome back. I'm Jeremy Szafron. This market rally is facing its biggest test yet. The White House is set to activate a sweeping wave of tariffs, 30% on EU goods, 35% on Canada, 50% on Brazil, all starting on August 1st. Now, bond yields remain elevated. Small caps are under pressure, and the fresh inflation data, the June CPI report, hits tomorrow. Meanwhile, Bitcoin just topped a new all-time high, just above 121,000. Gold is steady just below, or just above, I should say, $3,300. And investors are asking whether this market is pricing in reality or just clinging to hope. And joining me to break down what matters to investors, where this is all heading, and why the next 48 hours could be pivotal for the Fed credibility, we're talking to Peter Boockvar, of course, Chief Investment Officer at the Bleakley Financial Report. He's also the editor of the Boock Report, which I highly recommend to go and subscribe to on that Substack. Peter, always great to see you.
Great to see you. Thanks for having me.
Let's get into this business impact on tariffs. I mean, it's been making headlines all weekend. We're now looking at nearly $1.3 trillion worth of U.S. imports, with some as high as 50%. Now, you've said that this is like throwing mud on the gears of business. What are the second and third order effects here that the markets might still be ignoring?
Well, I think they believe, and I'm old school. I like lower taxes, not higher ones. So I'm not a fan of tariffs for that exact reason. I understand to an extent what some of them are trying to accomplish, but overall, I'm actually for lower taxes, not higher ones. And the problem with these tariffs is I believe that the U.S. is going to pay for most, if not all of them, with the weakness in the U.S. dollar probably making it worse. Whether it's consumers, whether it's businesses, it's going to flow through. And yes, exporters to us will eat some of it, but I'm afraid that it's going to be offset by that weaker dollar. So I don't think people are doing the math. They think that there'll be deals and everything is going to be fine. But we import about $3.3 trillion worth of goods, and a 10% baseline is $330 billion worth of taxes. A 15% baseline would be $500 billion worth of taxes. Now, some of that will be offset by USMCA with Mexico and Canada, but generally speaking, that's a large amount of taxes that we're layering on to the U.S. economy. And to my point about tariffs throwing mud in the gears of business, it mucks up and a lot of supply chains. And, I know there's this fantasy belief that we're going to bring all these manufacturing jobs back to the U.S., but it is a fantasy belief because there's just many things that we're not going to be able to make here. And yes, we do want to reshore or nearshore some of the things that we rely on China too much for, like pharmaceutical ingredients and other things. But that could have been done without slapping tariffs around the rest of the world and basically creating a trade wall around the U.S. I'm trying to, go back into history and my old economic books to find, any time when this was actually a prudent strategy and led to more economic growth. And I struggled to find any examples.
Yeah, interesting. I mean, go back to the tariff-related costs, because you're effectively saying that they're acting like a corporate tax hike, right? Quantify that for us a little bit. And what does that mean for the S&P earnings into Q3 and Q4?
Well, this year, we're in this fiscal year, the CBO estimates that U.S. corporate income tax receipts to the federal government will total about $525 billion. So if we're left with 15% tariffs on $3.3 trillion of imports, that's about $500 billion with, yes, some offsets on whatever trade agreements we have. But Trump's essentially taking back his own cut in the corporate income tax in 2017, which I was a big fan of. To me, the way that you create a competitive foundation to bring manufacturing and other businesses to the U.S. is to lower the cost of doing business here via even lower corporate taxes and deregulation, not by raising everyone's costs, particularly those of your competitors overseas.
Yeah, It's funny. I was going to ask you that question next because, I mean, President Trump's team argues that these tariffs level the playing field, right? And you've said that they create more distortion than protection. And is that what you would do differently then, Peter? I mean, what policy alternatives do you think would actually support U.S. manufacturing without feeding inflation?
I would have loved to have cut that corporate tax rate, which went from 35 to 21 down to 15. 12.5% was what Ireland had, and every manufacturer that possibly could went to Ireland. Let's become the next Ireland. That's what I would have done, and particularly focused on the deregulatory side and the permitting side. That would have been a real big help to reshoring U.S. Production and jobs. But again, there's many manufacturing jobs that are just not going to come to the U.S. I mean, we're past the point of people planting seeds in farms. Mm-hmm. It's going to be a machine that does it. It's just the way that society progresses. And in manufacturing, more robots are running these factories. That's just the way that society progresses. So to layer on tariffs and think that we're going to go back to the 1950s, I think was a delusional belief. And I understand that other countries have trade barriers, no doubt, and we want to do our best to knock them down. I just question whether this was the right tool to do that. And what we've seen so far is even those countries that say we're going to lower our tariffs to zero, well, we're not doing the same. And a lot of countries that we have trade deficits with, they have very low per capita income. First of all, a trade deficit is not bad. I don't know what economic thought goes into thinking that they're bad. So I think when you begin with a faulty premise, not good things come of it. But we just slapped a 35% tariff on Bangladesh. Their per capita income is $2,200. I don't think the average consumer in Bangladesh is in the market for a Ford F-150 that we can possibly sell to them. So I just think we could be really careful with this road that we've gone down.
Yeah. Let's talk about what it means for, inflation in that path. We get this CPI data tomorrow. The street's expecting 2.6 on headline and 3% on core. You've said inflation is here, but the question is, where is it in the supply chain? What are you watching in tomorrow's data specifically? Is this the moment that tariff inflation becomes real and not theoretical?
I'm not sure if it's going to be the June number, but in order to get a sort of a fuller inflation picture is not just looking at CPI Tuesday, but looking at PPI Wednesday. And what I think is potentially the most relevant is import prices on Thursday, because import prices are essentially the first touch to those higher imported prices. And if we look at May import prices, well, actually, let's go back to April. April core, so ex-food and energy import prices rose 0.5 month over month. In May, they rose 0.4 month over month. So the inflation is here from the tariffs. It's just we don't know necessarily to what extent it flows through that supply chain, which PPI, CPI will obviously give us some color. Now with CPI, the positive is that the services side should see further price deceleration as rental growth continues to slow. Question is whether we've seen a bottom on goods prices and whether we're going to see an inflection higher. I don't necessarily think June is going to fully capture that. It's going to be July, August that we'll see. One of the reasons that give me that thought is Helen of Troy reported earnings last week. They make everything from hair blowers to curlers to brushes to backpacks, just a variety of different sort of things you find around the house. And they said that this summer, they're going to be raising prices to their customers 7 to 10%. Now, whether Walmart passes that on to us or whether they'll be able to get that through Walmart or Costco, I don't know. But they're going to try. Some products are going to have no price increase, but they also said some products are going to have price increases as much as 15%, 15%. Then you have some companies like Conagra, which basically said they have no pricing power right now, and they're going to have to eat the tariff. So they said they have 4% commodity and labor inflation, and now they have a 3% incremental cost pressure, bringing it to 7%, with the incremental pressure coming from steel and aluminum tariffs because they package some of the food products that they make and that just led to a higher price. So they're going to get hit in margins.
Yeah.
But there's this belief that if consumer prices don't go up, then somehow tariffs are inflationary benign. Well, no, because if you're Conagra, who is getting slammed by this, well, you're probably going to spend less capex, and maybe you're going to hire less people. So the economy is still going to get impacted in some way by what we're seeing here.
Yeah, and I mean, lumber, copper prices jumped more than 7% in recent days. It seems like the broader commodity pressures seem to be kind of creeping back in. Not to mention, I mean, I just came back from Florida, and they came out with those 41% down on Amazon Prime days. I found it funny that Bezos was selling stock just before that announcement. But, with this commodity pressure creeping back in, is the Fed underestimating this?
No, because Powell has told us that he wants to see how this plays through. Right. So he's actually been of the opinion that I'm going to give this some time to see how it works its way through the supply chain. He wants to give it time to see how it impacts the economy and the labor market. So if anything, he's been pretty consistent with the belief that, this can go either way. And maybe this is a one-time thing. Theoretically, tariffs are a one-time change in price, but maybe this time, because of its disruption to the supply chains, it's not. And also, we're going to be crimping supply of things in conjunction with higher cost of capital that could eventually lead to higher prices, like in multifamily. But I think Powell has actually not succumbed to a lot of pressure to cut interest rates because he wants to see how the summer plays out with these things. I still think he's going to cut in September, but July was just too early for him.
Okay, interesting. That was I was going to ask you. It's like we're right on time here, because the FOMC minutes suggest no cut before at least September, maybe even later. But continuing climbs are climbing too, and lowing growth is stalling. I mean, if the Fed's mandate is both employment and inflation, are they falling behind on both?
Well, you can't say that with inflation, since the last inflation report has core CPI at above 3. Yeah. PCE, I know that they like to look at, but I think that's a faulty figure. That's a 2.7. So that's still well above 2. They're certainly not behind on that. The labor market, I think the economy is softening. I mean, I think the first half of this year, we're seeing basically 1% average GDP growth. And really the only pockets of GDP robustness has been anything related to AI, upper income spending, and government spending. Outside of that, the economy has been struggling. So, could Powell? Well, Powell himself said if it wasn't for the tariffs, he probably would have cut rates again. So that tells you where his main focus is right now.
Yeah, all in the while, I mean, I must bring it up. The White House is blasting the Fed for a $2.5 billion renovation project, calling it fiscal mismanagement. And, you just said, at a time when Powell is warning about these risks with inflation, asking Americans to brace for higher for longer rates. How damaging is this for the Fed's credibility, or is it all kind of part of that plan to get somebody new in there?
Well, it is, but I think that whoever the next chair is, it'll probably be the worst possible job you can have. Yeah. And from day one that you accept that job and you get confirmed, you're already soiling your reputation, because you're going to do what Trump wants you to do. And I don't see how that is a win situation for anyone in that seat, because you can be sure that it's going to be tilted to the whims of one person. And now, granted, there is a broader committee, there is a set of governors, there are Fed presidents. It is a group that votes, but the extraordinary amount of pressure is not going to be a good reputational thing if that chair succumbs to that pressure.
Yeah, there was a new story this morning on the EU, and I mean, they're now actively trying to deepen ties with India and Asia Pacific to kind of hedge against Trump's tariffs here. Do you see this as an early sign of lasting trade realignment away from the U.S., or just kind of a diplomatic noise before this August 1st deadline?
No, I think we've lit a fire under the rest of the world to say, don't rely as much on us and go find other suppliers and go find other customers. That's what we've done. I don't think that should have been the goal of what we were doing, but that's sort of the effect. I mean, China reported June trade data. Exports to the U.S. fell like 16%. and they rose like 17% to Southeast Asia. Europe knows that they need to find other suppliers. They're going to build out a bigger defense industry. They're going to still buy defensive products from the US, but they're going to try to rely on other suppliers even more so. So I do think that the rest of the world has been encouraged to trade amongst themselves and less so with the US.
Yeah, and on that theme, I mean, on the global macro front, I mean, the 10-year is back at 4.43%. You flagged global 30-year yield spikes last week from Japan to France. Is this a coordinated signal that sovereign debt risk is being repriced globally?
I think there is a global aversion to taking on too much duration risk, particularly in countries that have fiscal disorder. And Japan certainly qualifies. The US does, the UK does, France does, and now Germany potentially with their increase in fiscal spending, even though they're beginning with a much lower debt to GDP ratio. So I like to look at right now the 30-year because that is, for most countries outside of Japan, the furthest out on the maturity yield curve. And that's where we're seeing sort of the greatest pushback in terms of investor participation. So we had a spike overnight in Japanese yields. The Japanese 30-year yield, which that maturity goes back to 1999 that I have data on. It's basically at the highest level in 26 years, going back to that. And I think that's why the US 30-year is retesting 5% again. And we're seeing German and French and gilt yields all pressing higher on the longer end. So I think that is an important thing that people need to focus on. The equity markets don't care. They're not looking at this, but I think that they should. When it matters, I don't know. But to me, it's a very important dynamic that's taking place in long-term duration fixed income that we all need to pay attention to and not ignore.
And coming from that, the big print, I mean, you cited Japan's base pay rising at the fastest pace since 92. With that and European yields at multi-year highs, I mean, do you think that the era of disinflation is kind of truly over here?
Well, we never really had disinflation, because 2% in the US inflation every year is perpetual increase in inflation. If you look at Japan over the past 30 plus years and you average CPI, it was basically zero. So yeah, they had periods of inflation, they had periods of deflation, but overall they had zero inflation. Inflation in a fiat currency world, in a government fiscal spend, a largesse world, you typically have higher inflation. The debate really is more what the rate of change is.
Mm-hmm. What's more dangerous to investors right now, you think, Peter? I mean, is it duration risks in bonds or valuation risk in equities?
Well, valuation risk in equities is always a factor, but it doesn't matter until it does. The question is what makes people care. And I do think it's the two biggest risks right now are, yes, to your point, the rise in long-term interest rates. And number two, how the economy absorbs all these tariffs and what it means for corporate profits.
Yeah. It's going to be so fascinating to watch as we start getting some of these numbers too. And we got to talk about the fact that with this happening, Bitcoin's above 121,000. ETF inflows nearing $9 billion this quarter. Gold's continuing to tight band around 3,300. What's the signal here? I mean, is it the flight to hard assets or two very different investor bases?
I'm really not sure. And I say that because this rise in Bitcoin is happening with seemingly every day, every week. Mm-hmm. There's some entity that is announcing that they're selling debt or equity or both to buy Bitcoin. Everyone wants to be the next Michael Saylor at MicroStrategy because his strategy so far has worked out as well as it has. Everyone wants to be like him. So I don't know, is Bitcoin going up just because all these entities are raising money and just buying Bitcoin and buying is beget buying and sort of Ponzi-esque? Or is Bitcoin trading, like you said, as a hard asset, similar to gold and silver and platinum and other industrial metals? Right now, I'm more inclined to think it's the former. I hope for the longevity of Bitcoin, it ends up becoming the latter, but I don't think that it's proven itself to be that just yet.
Yeah, interesting. I mean, we got what, 120,000 here as crypto week kicks off in Congress. I wonder, I mean, we continue to kind of talk about Bitcoin and its role and whether or not it, people say, okay, 5,000 years of gold history and Bitcoin only has this. Is it just chasing policy chaos, the beta, or is it kind of that reinforced role as a hedge?
What you mean with Bitcoin?
Yeah.
Well, again, I think it's hard to say. I mean,
Yeah.
right now, because it seems like every week I'm reading about some SPAC that's buying Bitcoin. I'm inclined to believe that it's just, as I said, buying begetting buying, because of all these funds that are raising cash to do it. I think if Bitcoin wants to be similar to gold, it needs to be correlated to gold, and it really has not. It's been more correlated as a risk asset, more correlated with NVIDIA and the NDX and so on. Do I think Bitcoin can be another form of gold? Yeah, I think it can be, but it has to act like it.
Right. You've said you also prefer physical metals, but you also hold some miners. Do you see gold breaking out in H2, or is the market too focused on Fed policy to kind of allow that?
Well, getting my timing right is always difficult for me. Yeah. I've been a bull on gold for many years, and I do think it will continue to go higher. But whether it's a second half of this year thing after the consolidation we've seen over the past few months, yeah, it's very possible. I mean, if central banks add another 1,000+ tons of gold in 2025, making it the fourth year in a row, that will certainly remind everybody of this voracious bid on the part of central banks to diversify their holdings away from dollars that could lead to further increases in the price of gold. Then you add on what we've seen so far, the worst first half of the year of any year since the early 1970s in the dollar, and gold to me is only going to benefit from that. So I do not think the highs are in gold. As I said, whether we rally in the second half of this year, I don't know, but we're going to continue to rally in the price of gold and other metals as well.
I got to ask you, I mean, how would you position a portfolio right now across the hard asset spectrum? I mean, is it gold, silver, Bitcoin, energy, ags?
Well, a particular portfolio that I run here is we're long gold and silver and platinum and uranium. I'm very bullish on oil prices below $70. I believe they're cheap. I believe that to have them not decline on these continuous OPEC quota increases tells me that the inventory levels are tight around the world, and that OPEC is just raising quotas to where production already is. We've seen 11 weeks in a row of declining rig counts in the U.S. So I like ag too. I think there's a place to be had for these hard assets right now. Whether Bitcoin fits into that, I'm still unclear right now, as I mentioned before. And I think international stocks, via the weakness in the dollar and just the valuation catch up to the U.S. after many years of underperformance, is going to continue to be a thing as well.
Yeah, I mean, the S&P, it's trading, 24 times earnings? You've said that another decade of outperformance is unlikely. Is the AI trade done? I mean, where is the opportunity in this world of rising costs and flat, real growth?
Well, the AI trade has gotten a second wind here. Not necessarily a new incremental news, but it somehow did get a second wind. What has broken up more so has been the Mag 7 trade. The Mag 7 trade is splintered, where you have part of the AI trade, Microsoft, NVIDIA, and Meta doing very well, and then Google, Amazon, and Apple sort of dropping out of that 7 group, with Amazon sort of in the middle there. So that's what has splintered. And the 7 stocks make up about 35% of the S&P. The top 10 stocks make up about 40% of the S&P. Now, at some point, the AI tech trade will sort of break, as we're building certainly an enormous amount of data centers, and at some point that will be one too many. I'm not smart enough to know when that is, and this earnings season will be certainly an interesting tell on the state of that trade in terms of CapEx spend and so on. The issue with the hyperscalers and the spend is that it's a cost to them, while the beneficiaries like NVIDIA continue to benefit from still a robust level of spend.
Yeah, I mean, you recently also highlighted value stocks in Europe trading at a major discount to U.S. peers. Is this the time to be going international? I mean, look at Brazil. I mean, once those tariffs hit, people were going in and buying the dip. So
we've been bullish and long international stocks this year. We were long them last year too, so it's not like a new idea, but they're finally working. And actually, some international stocks, started working last year as well. The weakness in the dollar, the Mag 7 trade, as I mentioned, splintering, is waking people up to the fact that there are more than just 7 stocks to own. Not only are there 493 within the S&P, but there are stocks around the world that are pretty attractively priced and still the case. And this weakness in the dollar makes them even more attractive. So I think the international outperformance is a multi-year trend, not just a 1 or 2 quarter thing.
Yeah, what's the what's the most underpriced macro risk right now that could hit the portfolios hard in Q3? Everyone's asking. Everyone's even the markets are sitting here watching today.
It'll be a recession-induced tariff impact and or a continued rise in long-term interest rates, where the 10-year breaks above 5 and we see higher yields around the world. That would be, if there were to be a catalyst for breakage, those 2 things would be it.
All right, Peter, I got to ask you, what are you watching between now and the September Fed meeting that could drastically change this whole thesis?
Well, the market's hanging on to the belief that Fed rate cuts are going to save the day, and that whatever economic challenges we face with tariffs is going to be offset by Fed rate cuts. And the belief that that will spill also through the rest of the yield curve. But after we saw the Fed cut 100 basis points in the short end in 2024, long rates went straight up. I think we're going to see a repeat of that. So someone looking to buy a house and relying on a 30-year mortgage, I do not believe is going to get relief from Fed rate cuts. And if it also leads to further weakness in the US dollar, that can further drive longer-term interest rates, because a weaker dollar from here, after the 10% decline we've already seen, could lead to a higher imported inflation, further complicating the job of the Fed.
Yeah, what a time. What a time. Hard to get the real picture at this moment. Peter Boockvar, always a pleasure. Appreciate this. Thanks again for joining us today.
Appreciate having me. Thanks so much.
Thank you, sir. For more market insight and macro strategy, be sure to subscribe and follow Peter's work at the Boock Report on Substack. All right, stay tuned. We got a lot coming as inflation data drops tomorrow. I'm Jeremy Szafron. For all of us here at Kitco News, hit the subscribe button. We appreciate your support, and we'll see you next time.